And we actually have the terms for that one, so I gotta pull those up. Or maybe you can pull that up on Salesforce. We'll mark that before, 'cause it's Does anyone have a form that they filled out that we didn't get yesterday? You can raise your hand. Or when you're done with it, if you're filling it out now, if you could just hand it to Renell in the back. Okay. Or if you need one. Does anyone need that consultation form if you haven't received it? Okay. Let's make sure.
New people.
Okay, so typically what I do, where I start is I take into consideration what your investment all in that property is going to be. So Denise, it's Denise, right? Denise, you purchased this package. Your price for the Detroit house was $3,000 plus $1,000 buyer's premium and the $1,600 BHPH fee. So your all-in was $5,600. So what I do is typically our terms that we start out with are 240 months. So I'll plug into our fancy financial calculator 240 months as the term. I'll put in a desired annual return on investment, just a gross return. Where do I want to start marketing this property? And we'll just kind of start with a 40% annual return, which is pretty good regardless of the investment, right? Now, do we always get 40%? No, okay? But that's gives us a lot of room between, yesterday I explained my minimum goal for you, the floor, is what? 20. So if I'm starting at 40 and I know I have as low as 20 to go, I've got a lot of room to work in there, right? Yep. Now when we go to the property, we do our site visit, we put our sign up, and our sign it's bright and yellow like our Buy Here, Pay Your Homes logo, and you can't miss it. You're driving by, it's almost blinding. And we put a down payment and a monthly payment. So we'll start higher knowing that it's easier to come down closer to that 20% than it is to come up. So that's what we do. So I'll start with a 40% return, knowing that my goal is a 20-year note, and then we'll calculate that and throw in your invested amount. So we have $5,600, which Denise has already paid, at closing will have already paid. What's the marketing fee when we sell your property for you? What's that? $1,500. Good. So I'll add that to the $5,600 because even though Denise hasn't paid that yet, at some point when we sell that property on her behalf, she will have paid that. So we want to make sure we calculate that in the return. So then we're at what? $7,100. Okay. Now we'll market this with a down payment. Typically, the minimum down payment we try and get is a $1,500 down payment. Why do we do that? Right. So that covers your marketing fee, and then it just cancels out, and then there's no cash out of pocket other than what you've already paid to get that deal done. Now, do we always get $1,500 down? No. And we're using this example, Detroit, as maybe one that's not quite ideal for that. So in this case, I'm probably not going to do $1,500 down on this. Why? It needs a lot of work, right? So someone's going to have to go in there. We want to make sure that they have their cash down. You might say, well, if we're only doing a $500 down payment, I'm not sure about that. Don't we want more to make sure that they follow through and don't default? Well, the hope is that as soon as they close, they know the work involved. They're going to get right to work. They're going to pour thousands of dollars into that property just to get it started. So that kind of serves as a de facto down payment as well. All right. So if we're only doing $500 down on that property, then Denise's investment at that point, we want to subtract the down payment. So we go from $7,100, which is the cost of the property, the buyer's premium, the BHPH servicing fee that she's already paid, and the $1,500 marketing fee that she's about to pay for the closing. And then we're going to deduct the $500 from that, and we get to $6,600. You guys all with me so far? Yeah. Any questions? I'm getting real detailed here because I want you guys to understand our thinking behind it, and I want you to feel comfortable with the process of what we're doing to sell your properties on your behalf. Okay, so we're going for a 240 months, 40% return. Your investment is $6,600 after all the fees and the down payments deducted. Chuck, what do we come to on a monthly payment there? 220.
You might have missed it, but it seems like it's 76. Is that $1,000 she needs to pay on the additional market fee?
I already added that in. So we've got a $5,600
Get
today.
to 71. Got it.
Then we add $1,500, so we're at $7,100.
Yeah.
Those are all our fees and the cost of the house. And then we deduct $500 for the down payment that we collect. So her investment at that point is $6,600. So to get a 40% return on that, annual gross return, we're looking at a, Chuck, what did you say, $220 a month payment, okay? Now, Chuck, can we go back to the Zillow page for that? And let's look at the Zestimate range. So see here, we always, as I mentioned yesterday, we want it to be cheaper to hang on to this house than it is to go anywhere else. So look here, whether this person is moving in this house or they're going to rent it out, they've got plenty of spread there to make this work. And I mean, who pays less than $220 a month for their car payment? I mean, really. So even at $220, you know, someone should be able to carry that forever, whether they even touch that property. And so that's why we want to get you the return. A 40% return, I mean, we'll go to the bank with that all day, right?
Yeah.
And so, and $220. So now that, so Chuck, how long does it take to get that paid off, to recoup their initial investment? We've got $6,600. It's going to divide that by 220. So we're looking at 2.5 years, okay? Now how long's the note? So we've got 210 more months, I don't know how many years, you know, 17 years to collect that. Now, we haven't been in business long enough to know if they're going to pay for the 20 years, but who cares? Because we know that they're going to, you know, your investment's going to be back in 30 months, and then it's all just icing on the cake. Yeah.
Don't you need to deduct the insurance or the servicing?
Yeah.
Yeah, that's a good point. Yep. So the monthly, if you choose, and not everyone chooses, most people do, but you know we haven't even gotten there yet. So if we took into account the $35, so that adds, you know.
Well, it adds 8,400 if you went all 20 years, but if you added like 3 to 5 years, the initial calcs, because it probably is going to resolve
Right.
somewhere before that.
Right.
8,400 might be heavy, but a couple grand would be good.
Yeah. So now, Chuck, can we do, what's the worst case? Let's say, you know, this house sits empty for a couple months, and we're maybe getting lowball offers, or we're getting not a lot of activity, and finally someone comes in and they offer. What would be what would a 20% return look like?
Yeah, 1, 2.
And so while he's calculating that, so
50% less than that.
So, you know, $112 a month, and it's still a 20% return. I think something that we all would be happy with as well, right? And so, these terms work. Chuck, what would be the overall paid? I don't know what's the term I'm looking for. The amount paid over the full life of the note. Full amortization, and then also, yeah, the sale price of the home. So what's that going to look like? The note price. And then George Knorr is going to be here a little later. He's going to be talking about notes and some things that he's going to be making available to you. And we can maybe come back when George is here, go through some of these examples and look, okay, if we've got a note of this, and the Zestimate is this, and the monthly payment is this, and your investment is this, you know, what is the going rate on the market for a note like that? And what could you expect on the sell of that note?
It's about to get crazy in here.
So hopefully you guys appreciate. I know this in the rush and the hubbub of times like yesterday, a lot gets missed. There's a lot of details, and I know it's a lot to take in. So I'm glad you guys are here, and I'm glad we're having the opportunity. We've never been able to do this before, so this is really beneficial. Any questions while Chuck is working through that directly related to how we come up with the numbers? Anything that I haven't kind of brought up or mentioned? Yeah.
Just clarification, how did you get the monthly payment of $220?
So we worked backwards. So Chuck ran 240 terms, a rate of return of 40%, and then the investment of, well, it was 6,600. And then he calculates what monthly payment gets that. So we kind of work backwards. Everything that we do kind of goes against the grain and kind of the, most people think, the first thing they think of is what? That overall sales price, right? Well, what's this house worth? But see, price cures all, and the owner financing cures all as well. And so that's why we start with, we want a return. Well, what gets it?
Broadens the market.
Mhm. It broadens the market.
So what's the number?
Chuck's,
How did you arrive at the term for 240?
that's just our standard. We always start with 20 years. And here's the thing,
30,
we,
real quick, I did share, I've been, because out of habit, I speak about 30 years. I speak of 30 years. Garland has, and Chuck's involved, realized that you can increase the rate of return by condensing the amount of months, and we've gone to a 20-year for the most part. Sometimes it'll be 15, 17, 18, whatever makes sense.
Do 25 if it needs to be.
yeah. So we'll do anything that works for the buyer and makes sense for you and gets us that desired return, we will do. So we'll have people call and say, we've got an offer right now. We haven't closed yet, but we've got an offer on, Nate's not here this week, huh? This weekend. We've got a gentleman that we met last month. So we're getting, I think what was his cost on that house in Lansing? I want to say it was about 14 grand, maybe 12 grand, something like that. Or maybe you can pull it up. But the offer is $6,000 down, and she's wanting to pay it off in like 4 years. I mean, that totally makes sense, right? I mean, why would we say no to that? Especially with a $6,000 down payment. We always want a higher down payment if we can get it, or a higher monthly payment, because those are the two factors that bring your return up the most. We don't have a prepayment penalty. Why would we? If someone wants to pay it off faster, that works to your benefit. So you can get your cash back faster, just roll it into more properties. Everyone wins. Yeah.
Can you have Chuck give us the formula that he actually puts in to figure out that 220? How you write that monthly
Yeah,
payment?
let me walk you through. So what was that going on?
On the, it's right there, 19,980. So if you've got a financial calculator or you use anything, okay. Your term in is 240. Okay, your interest rate is 40%. Okay, your present value is the amount you have invested, which in this case, after we sell it, you'll have 6,600 invested, and then you calculate the payment. Okay, then if you want to convert to the next thing you're going to do is convert to the note, what the note would be, and then add the down payment, you'll get the sales price. In my rush, I don't know if I did that exactly right, so it'll be 500 low or high. So now that you've got the payment, change the interest rate to 12%, because that's the rate that's on the note, and then calculate the present value.
Present value or future?
Present value.
All right.
Because that's what the person's going to pay today for that house.
Yeah, it's
So,
19,998 without the 6,600.
okay, so the sales
Excuse me,
price,
without the 500.
right, so the sales price would actually be plus 500.
Yeah.
Okay, so let's do the tax part again. So it's going to be, interest rate is 12%. The present value is going to be what?
You're going to calculate the present value.
Yeah, you just did it.
That's what we're trying to look for, the present value.
Yeah, that's the sales price.
That's the sales price.
Which is then going to generate 12% interest over 20 years. So, to get out.
Well, that's the note rate is 12%,
Right.
but to you, it's going to generate 40%
Right,
because you
that's what I'm
have
saying.
6,600 invested.
So that comes to 20,498.
That's not the sales value.
Sales price, right?
Yeah, that's what you saw in the current folder to your buyer.
Either one. There is it's not that expensive, but there is a Texas Instrument Business Calculator. Let me see what the app has on it. If you look in the App Store, it's the Texas Instrument BA and then Roman numeral 2 plus calculator.
The 10B2B is one of the TI.
Yeah, BA 2 plus.
You know what would be great is maybe we can do a webinar, walking people through that or something, and show you So all of our asset managers are equipped to, on some level, we've also created, Chuck put together this formula in Excel form, so it's kind of plug and play. And there is maybe if we have time, we can show them the mortgage calculator that we use online,
Yeah.
because that actually,
Amortizes it, that's the whole thing.
we can calculate the return. Steve, can you email that link to Chuck, to the mortgage calculator?
So if you find that the 19.8 is a little too high, you tweak it, so you might make 35% return and.
Right. Right, so, yeah, this is the goal, this is the floor, that's our minimum goal. And so this, we will probably not end up there, and we probably won't end up there, we'll be somewhere in the middle, maybe a 30% return.
Yeah. I was just gonna say $112 is really cheap. Yeah. You pay $35 on that, you're paying almost, what, 30-40% in fees for that payment. So I mean, in that case, I know Garland and his team would be shooting more for 175 as a low, probably wouldn't come below 175. But
And-
Detroit is gonna, because you're paying so little for the house, it's gonna bring the rent rates down. But when we go to the Florida house, we'll do the same thing with the Florida house.
Now, if someone offers, they say, there's no way